Happy Valentine's Day. Hope that your Valentine remembered you and you remembered your Valentine this week. A few housekeeping items as we start week 5. Can you believe the course is almost 1/3 of the way over? The first assignment is due on February 20. I did extend the due date for that. Note that many of the property flyers you saw for last week included some kind of regional market analysis. I point that out only because it is an important component of developing a management plan for a property, and as you can see, it's even used as a marketing tool because many investors don't even live in Idaho. They may be buying property from somewhere else, so it's an important factor in making an investment decision. I don't expect that the market analyses done in those flyers is exactly what yours will look like, because I gave you very specific components that I want you to include. But if you are interested in seeing what that sort of thing looks like, you can go back and refresh your recollection. I did ask you to describe these things in writing a little more. Some of them just included mostly charts and graphs, which is nice, but I asked you also to discuss those things and perhaps what they might mean to making an investment property decision. Of course, it depends on what kind of property, but that also is something that you're being asked to decide. So it's a little bit different, but you get the general idea by looking at the flyers that we had last week. Make sure you include all the components in the assignment and follow the directions exactly, because that is important in my grading curve. I like to see that you have been able to read and follow instructions. I'm all about that. Also, the quizzes, I just wanted to touch briefly on the quizzes. You know, I don't know if you were aware, but I do make the answers available for a week after the quiz closes. So if you want to see what you got right or wrong, it might be helpful to you in preparing down the road for the final exam, just as a review to see what you missed and why. And if you have any questions about those, please feel free to ask, but I do leave those open for 1 week after the quiz closes so you can see what you got right and wrong. And finally, I haven't heard from anyone about last week's announcement. I offered some extra points if you were able to determine or tell me where you think that sign is in Idaho. And make sure you're reading the announcements and have that option selected in your preferences, because I do post things almost every week, and I would like for you to be getting that information. I really enjoyed reading your discussion boards from Chapter 4. I thought that a lot of you made some very interesting comments, and it was interesting also for me to see what exactly struck home with you. Some of you picked up on very different components of things, and I enjoyed reading what you had to say and your opinions on those. I'd say overall it was a very good job on those so far. I haven't got through all of them, of course, and they aren't graded yet, but I thought you did nice work. This Chapter 5, if you like numbers or have any accounting background, this is the chapter for you. It is most likely the most number-filled chapter you will encounter, and you will need this chapter because the next assignment, Assignment 2, you will be doing a financial analysis and a forecast budget for a property, and this is helping set the stage and helping get you ready to be able to do that. I did post some financial analysis forms in the files on the left-hand side, and I also put them in Module 5. Again, those are Excel documents, but they open in PDF if you're just clicking on the name link, and you can look at those either way or use them for your purposes next assignment. They are not, the formulas aren't in them though, so you have to do the math. I will tell you that the thing about the numbers is it's like statistics. You know what they say, there's lies, damn lies, and statistics. Well, it's kind of that way with numbers. You can kind of fudge them to make them say anything you want. But by and large, they are somewhat concrete. So the important things that I want you to take away from this Chapter 5 when we talk about numbers and accounting for property management are the following. The first thing the chapter touches on is trust accounts and bank accounts. I cannot stress to you enough the importance of accurate accounting when you are taking care of someone else's money. There's a word that is commingling. It's a bad thing, generally speaking. It means that you have combined some of your money with that of your clients or your owners. Now, if you're managing your own property and that's all you're doing, you can do whatever you want. That's up to you. Nobody cares if you are taking money from one property and using it for another. It's all your money. It's fine. It doesn't matter. But if you're managing property for someone else, man, is it huge that you keep your money absolutely segregated from that of your clients and owners. Some of the biggest problems that we see in my line of work are from people who have gotten into a little bit of financial trouble, and they see this bank account sitting there and it has a lot of rent in it, it has a lot of security deposits in it, and they think, oh, I'm just going to borrow $1,000 this month to make my bills, and I'll pay it back next month when I have a closing or when I get some more money in or whatever. And you know, this is how things go bad in a big hurry. You need to really understand that that is never okay, and in some instances can be even considered a crime. I will tell you that if you do that in your real estate transactions, you definitely will be have a discipline imposed, and in some cases we have revoked licenses for people who were not able to properly handle clients' money. We don't regulate property management in Idaho, so this is kind of the honor system, but it is huge, and I know of so many cases where people have taken money that didn't belong to them with good intentions of paying it back and were not able to do that, and have gotten into a lot of lawsuits, have been driven into bankruptcy and that kind of thing, and it's not good for anybody because the owners then don't get their money either, and that's never a good place to be. So I just really want to impress upon you how important that is. The other thing is that if you have several properties that you're managing for several different owners, or you're working for someone, and let's say you have 5 rental houses and 5 different owners and you're managing those properties for them, and the hot water heater goes out on property 2. The owner, you look in the owner's account and he doesn't have $500 in his account today that you can go out and use that to buy a hot water heater. So you just look at owner number 4, and owner number 4 he's flush, man. His property has been rented out and he's got tons of money that you haven't sent to him yet, or maybe a security deposit sitting there for $1,000, and you think, well, I've got all this money in one pooled trust account, which is fine. You can do that. You can put everybody's money into one account. And you think, I've got enough. I'm just going to take that $500 and I'm going to buy the hot water heater for owner number 2. And then I'm going to send him a bill, and I'm going to have him pay me back that $500. And then we'll all be square and nobody will ever know, it doesn't matter. But you know what? It matters. That also is an example of commingling. And that is not appropriate. So whenever you have got multiple owners in money in one account and you're responsible for that money, you need to make sure that it's completely segregated at all times. And if you need a hot water heater, then you might have to take money out of your own pocket to buy the hot water heater, or you might have to not do it until the owner coughs up the money, because you can't take someone else's money and use it for a person, or yourself. So that's the bottom line. The money is the money, and you have to account for it. The good news is there's a lot of accounting software out there that you can set up different client accounts and you can give people their accountings, because that also is an important component of property management, is showing the owners they've trusted you. Remember, you have fiduciary duties to them. They've trusted you to handle their property and their money, and they want to know that it's being well cared for. That's where you come in, and that's where it's important that you have everything to the penny precisely accounted for, with receipts and documentation of what you have spent and how and why. So if there's ever any question, that you can't be held liable for that. Unfortunately, I've also seen cases where property managers have collected rent in cash from the tenants and then told the owner that the property was vacant. We had a case in western Idaho, not here in Boise, but a little ways out, where the owner lived in another state, and he said, I don't understand why this property isn't rented out. And the property manager said, man, I just can't seem to get it rented. I don't know what's going on. I've tried and tried. I'm going to keep trying. And meanwhile, this guy was getting suspicious because he kind of heard that it was kind of a good market for owners and landlords in this area. So he hired a private investigator, and sure enough, they had the guy do some drive-bys and find out there really was a tenant living in the house, and there had been the whole time, but he was paying the property manager in cash, and the property manager was putting the cash in his pocket and then lying and telling the owner that it wasn't rented. Not good. So these are all things that I have many stories about this and don't want to bore you with them, but I just will tell you that it's a serious issue, and how you can really set yourself apart if you plan to go into the property management business is by being unfailingly ethical and scrupulous and precise in all of your bookkeeping and all of your accounting practices, because you will get a good reputation for being faithful and true to the people that you work for, and that is a good thing. And hopefully then you can also sleep at night too. The second big thing that I wanted to talk to you about is how to calculate income and expense for the purposes of doing financial statements and also for forecasting and budgeting. There are several different kinds of expenses, and they're not all used for every purpose. So when you figure out net operating income, NOI, you'll often see that acronym used. That talks about how much money did I make if I take all the income I had from the property and I subtract all the operating expenses. Just the operating expenses, mind you. Now, what's an operating expense? That's something that you need to run the property on a regular basis. It could be insurance, it could be management fees, it could be you had a broken window and you have to repair that. But what it's not is making a mortgage payment, paying your income taxes or the owner's income taxes. It's not making long-term capital improvements to the property. So you need a new roof. Well, is that a maintenance or is that a capital expense? Probably it's a capital expenditure because you're improving the value of the property. If you repair the roof and you have a leaky spot, that's probably a repair, which would be an operating expense. And last but not least, an operating expense is not depreciation. Depreciation is a sort of a fictitious expense that's used in calculating income taxes, and that's the only place it's used. So that's not actually cash out of your pocket, and so that's not an operating expense either. There can be fixed or variable operating expenses. If you have a fixed expense, for example, your insurance premium, you know every month it's this much. Or you have you have a fixed amount that you know is the sewer bill every month. Say it's $100 a month for the sewer for the building. It's always $100 a month. You know what that is. A variable expense could be something like some other utilities where you're billed on how much you use. So if you have a really hot summer or a really cold winter, you might use a lot more electricity or gas. If you have a drought year, you might use a lot more water than if you had a rainy year. And so those things you can kind of estimate, but they could fluctuate sometimes wildly depending on how many units you have. So those would be an example of variable expenses. And also maintenance. Maintenance, you don't know. You might go a whole year and not have anything you have to fix. Or you could have a really bad year. Murphy comes to visit. The washing machines break in the laundry room. The roof starts leaking. A mouse chewed through a wire and you have to replace a bunch of stuff in the building. Those are all things that you can't always predict, no matter how well you maintain the property regularly. So sometimes poop happens. You have a hailstorm, whatever, broken windows. So those are things that would be examples of variable expenses. Now, how do you know whether something is repairs versus capital? You have to kind of take it on a case-by-case basis again and just look and see, is this really, what's the amount? Usually the larger amount items are capital, and the government expects you to capitalize them, and that's more common. And then the one-time things that are less, like something breaks, for example, that's often a repair or maintenance and not a capital expense. So you take your net operating income, you subtract your debt service, and if you know what debt service is, that's your mortgage payment, or how much it costs you to service your debt. So your principal and interest payments on any debt that you have, and you subtract that from your net operating income. That gives you your cash flow. Now, cash flow is not pure profit. It's cash in your pocket, of course, and it indicates generally what you can expect for profit, but you have usually some other things that you have to take into consideration. And we are not accountants, and we don't expect you to be accountants. And let me tell you, unless you are an accountant, it's really good not to give advice on any of this kind of stuff, but you need to have a general understanding of how this works. And again, if you look back at those property flyers that we had last week, you will see a lot of this financial information is included in those marketing pieces, because it's the first thing everybody wants to know. What am I going to expect to see for cash flow on this property? How much does it cost to run the property? And then you get to the capitalization rate, the cap rate, which we touched on briefly early on in the semester. The cap rate is something that people look at to decide how much they want to pay for a property or how much they think it's worth. And it also indicates the level of risk that the investment poses. Now, the discussion board for this week does focus on cap rates, and there is a little more detailed discussion of cap rates and what some of the indicia, what those things can mean. And so I want you to take a look at that, and also then you'll have an opportunity to look at your properties that you looked at last week, your same two I want you to use, and I want you to look at the cap rates for those and tell me what they mean to you based on the information that I've posted in the discussion board. That'll be your assignment. So the last but not least, the thing that you need to estimate is the vacancy factor for your property. And again, I think if you look at those flyers, you'll see that there's a number plugged in there. So these are very common things, not just something the book made up, like, hey, we think this would be awesome, but they're really things that people use. And that it's good to have that. I think if you go out and look at any flyer for any property, most of them will include that, unless I think one of the commercial properties, the office property, said they would give you the rent roll upon request, which means they want you to sign a confidentiality agreement first before you go disclosing how much people are paying. The reason for that, by the way, often is maybe they gave one tenant a lot of concessions to get that tenant to move into the building, and they don't want the other tenants in the building to know how much or how little the guy next door is paying. So they don't kind of want that out floating on the street. It's very common in investment deals that you will be asked to sign a confidentiality agreement before you have access to the actual financial numbers, to see rent rolls and that kind of thing. I noticed that some of them will give you all of that right up front, and it's no big secret, but others of them it is a secret, especially the higher end properties. And when you have high end clients who don't want that information out. So those are just some things to keep in mind for this week. I hope that you have an awesome week. I also hope that you will let me know if you have any questions about anything in these assignments. I know for some of you, this is the very first time you've had any exposure to some of these concepts. For some of you, it may be cake because you've had accounting classes or bookkeeping or finance and you've seen all of this stuff before. Others of you, you might just be like, didn't even mess up my hair, it went so far over my head. Really, I'm here to help, so feel free to call me if you're stuck, and let me know if I can help you with anything as you get ready to turn in your assignment. I believe I have set that up so that you will upload your file into Canvas, and if you try and you have trouble, if someone could please let me know, I would appreciate it, because this is the first time I've used Canvas and I'm not 100% sure I'm doing everything just right. So I'm not trying to make your life difficult, but I might just not know how to do it. So let me know if you're having trouble, because that helps me too. Thanks. Have an awesome week.